Good evening and welcome to tonight's session of the Covered Options Online Learning Club, otherwise known as Cool Club. I know we have some new folks in the audience and I want to welcome you. We are fairly laid back here in the Cool Club, and so if you have questions, feel free to type them into the questions box and Lori will get them to me. Hope you enjoyed tonight's session and join us for others. I'm your host, Paul Madison, and the resident Cool Club dude. If you want to write to me, you can write to me at the Cool Club discussion list, which is cool_club@bivio.com. This is our usual disclaimer about options. Options do involve risk and are not suitable for all investors. All club members or individual investors should understand the risks associated with options or any other investment instrument before investing. Also on the slide are places to go to help learn about options as well as stocks. So what is Cool Club? For those of you who are new, Cool Club is a weekly 30-minute session where we explore the thought processes associated with doing covered options. Some nights, like tonight, we'll explore side topics that are related to selling covered options that I believe will help you better understand them. An often asked question is, why does Paul only believe in selling options rather than buying options? Isn't it just two sides of the same coin? You're in luck because we will explore this topic at next week's Cool Club session. The following week we'll also do an extra topic about what you need to do with your broker to be able to start selling covered options. By the way, I would love other people's experiences with brokers other than Fidelity, Schwab, and Options House, as these are the only three that I can speak about directly. On the third Wednesday of the month, we'll go back to talking selling covered calls, and the fourth, selling cash secured puts. And I'm afraid of Mr. Volatility, so we're going to skip the fifth week, which is Halloween. Here's our Cool Club homepage. The link is www.bivio.com/cool_club. Both handouts and recordings are under the presentation links, so if you're new and haven't listened to earlier sessions, you can go out and start from the beginning and listen to all of them if you're interested, or at least download the handouts and look through those. You can join the email discussion list by clicking here. Under Resources and Tools, you can get the Excel spreadsheet Cool Tools. And finally, the schedule and registration links are here. So tonight, we are going to spend most of the night looking at volatility. To begin with, much of this discussion will tie to how volatility relates to selling covered options, but towards the end we are also going to talk a little about how volatility can impact general saving and investing. Then we'll look at some great homework posts. I'm very pleased with the postings, and I'm sure it is getting others thinking about giving this a try. Then if we have time, we'll have an open floor discussion around any questions on covered options, options on specific stocks, and or cool tool questions. We finally get to meet Mr. Volatility. I've mentioned him from time to time, but have put off talking about him, and he was really starting to get a complex. I decided it was time for us to let him out of the box. So what is volatility? Well, at its simplest, it is just a measure of the movement or variability of a stock's price over a period of time. And why do we have so much movement in the stock price? Well, it is driven by two fundamental emotions, fear and greed. Stock prices are always anticipating what a company is going to do in the future. The market's reaction to small bits of information can be exaggerated. Why is that? Well, in today's market, information flows freely and quickly, and so we all know at essentially the same time the good news and the bad news, which tends to shift the balance in the marketplace. In a normal market, We have a reasonable balance of buyers and sellers, but good news or bad news will tend to shift the balance heavily in one direction or the other to excess. So why is it fear and greed? Well, bad news makes owners of stock concerned that the future is not rosy and that they should get out while the getting is good. But when it is good news, people think the sky is the limit and they cannot wait to jump aboard. Often volatility can seem like the boogeyman waiting to get you. But like most monsters, the more you understand them, the more you realize that they are not so bad. If you figure out how to play with them, they can actually be your friend. By the way, if there was no volatility, there would be no reason to sell covered options. Volatility is the only reason the option market is around. So let's go back to the 70s. There were two professors by the name of Fisher, Black, and Myron Scholes, and they decided they wanted to be able to calculate what a fair value for an option premium was. Their work has been immortalized and is called the Black Scholes model. Understanding the Black Scholes model in detail could easily be a 5-hour credit course at a university, so we are not going to go into a lot of detail. We're just going to cover a little bit that I think will open up some doors for you. When they finished their model, there were 5 pieces of information needed as input to be able to calculate an option premium. First, we need the stock's actual price. Okay, I understand that, and that's easy to get. Second, we need to know how much time is left to expiration. Okay, again, I get that and can calculate that, or the broker will tell me. Then the strike price. Piece of cake, got it. Then we get into 2 bits of information that need explanation. First, risk-free rate, followed by the volatility of the stock. How do I calculate that? Let's start with the easy one first, risk-free rate. Investopedia gives us a definition that says the theoretical rate of return of an investment with 0 risk. That's a mouthful. I know we all want to find that mystical investment instrument that has 0 risk, but it probably is still hiding. Despite what we may feel around the risk of government debt, which in of itself could be another 5-hour credit course, the generally accepted proxy for an investment vehicle with 0 risk is the U.S. government 10-year Treasury bills. Earlier today, they were quoted as yielding just under 1.63%. Okay, so that leaves us with volatility. Again, let's look at an Investopedia definition. It says volatility is a variable in option value formulas showing the extent to which the return of the underlying asset will fluctuate between now and the option's expiration. So the key here is the underlined section, which says it is the extent to which the return of the underlying asset, okay, that's our stock, will fluctuate. Okay, so how do I figure that out? Let's go back to our buddies Black and Scholes. When they did their model work, they actually derived the underlying stock volatility. Now, don't forget, they were college professors, so they enjoyed figuring out the math to do this. And I guess it was worth it, as they won a Nobel Prize in economics for their work. But I digress. As I was saying, they actually derived the underlying stock's volatility, and then they used it in their model along with the 4 other inputs, and they were able to calculate what the theoretical fair value for an option should be. Of course, you probably don't want to have to do that math. And in the real world, the Black Scholes model is not used to set option premiums. Option premiums are set by the marketplace. It is buyers and sellers agreeing to do business at a certain price that drives what the option premiums are. I imagine buying and selling is something that you're a bit more comfortable with than complicated mathematics. So now you're saying, okay, Paul, if the Black Scholes model is not used to set option premiums, why did you waste my valuable time talking about it? Well, the answer is because if I start with an input of a known option premium from our real market scenario, then I can use the Black Scholes model to back calculate what the volatility assumption had to be to justify that real-world premium. We call this implied volatility because if a real-world option premium makes sense, it implies that you must have thought that the volatility was this implied volatility. Now you say, okay, I get it. I can use the BS model, abbreviation intended, for something, but why do I care about implied volatility? And then I hear you say, so do I have to learn how to use that BS model to calculate IVs? And I guess I'm starting to think you're getting as impatient as Mr. Market. So no, you do not have to calculate them. The good news is most brokers and some free sites will do all the heavy lifting for you and calculate your IVs. And why is it important? Because it gives you a measure to use to compare unlike things. For example, let's first look at the broad market by looking at SPY, index ETF of the S&P 500. So here we are looking at the option chain on Fidelity for SPY near the money for October 20th expiration. And notice that right here there is a little button that says Show Analytics. Now some sites and some brokers will use a term like Show Greeks instead of Show Analytics. They're both the same, either one will work. And if I click on that, I get several more columns of information. And for right now, I'm going to ignore fraternity row on the end and just look at the column that is titled IMP-VOL, which stands for implied volatility. So you see we have an IV calculated for each strike that is based on the last actual trade. And we can see that for SPY, the IVs range from about 12 to 14. Remember, SPY, as I said, is an index ETF based on the S&P 500 that is viewed as a proxy for the broad market. So looking at its implied volatility gives you an idea for how volatile the market is feeling. For comparison, this is Coach, also taken after the close yesterday. You can see when we look at the individual implied volatilities, they are significantly higher and are in a range of 36 to 40. You might also note that the implied volatilities are going up when we both go further out of the money and when we go further into the money. Keep this in mind as we look at a few others. We can also just look at the difference in implied volatilities between different strikes for the same stock and the same expiration. Notice in the case of Apple calls for expiration this Friday that the IVs get fatter as we get deeper in the money. So on the calls, that's as prices go lower. Now let's look at two companies to see how they compare. Here we're looking at Apple puts and Procter & Gamble puts, both at near the money strikes. You can see there is more angst in Apple's premiums, up around an IV of 30, than there is in Procter & Gamble's, which for the most part are in the teens. Notice in this case both companies' puts are getting fatter IVs the further out of the money, still means lower prices, you go. The richer IVs as strikes go down on price on both puts and on the calls, as we saw in the last slide, tells me the market is more worried about price correction than the market going up. And finally, we can compare different expiration periods. So here are Apple puts for next month, expiration of October 20th, and January of 2014. In this case, the market is actually more worried about the future than they are in the near term, as we can tell because of the higher IVs. So January of 2014, we're at 36, 37 range, where for next month, Apple is in the 30 range. So there is more angst about Apple when you go out over a year out in the future. Option traders like to look at something called the VIX. The VIX is a composite of the implied volatilities for a wide range of options, the S&P 500 index, for the next 30 days. Looking at the VIX gives us a nice perspective on what the volatility of the broad market is. Here's a chart of the VIX over the last 3 years. You can see that it has ranged from low double digits to just above 40. But we can also see we have spent most of our time in the 17 to 25 range. Does anybody recognize the spikes in May 2010 or August 2011? Well, I went back and just tried to refresh. In May of 2010, what I found was that was right around the time of the BP oil disaster in the Gulf. There was also news about retail sales falling unexpectedly. China had announced that they would untie the yuan from the US dollar. And finally, there was a terrorist scare in New York City because a car bomb was found in Times Square. Maybe somebody in the audience can remember something else, but those appeared to be some of the items that gave the market a lot of angst. I think most of that probably was the BP oil disaster. August 2011 is a lot easier for us to remember, as that was the U.S. debt crisis, which we remember all too well. Okay, so why should I care about implied volatility and how do I use it? So implied volatility is not something that comes into the cool tool or that will change the APR calculations. What it does do for you is provide some context. Using the VIX, we can tell whether the broad market volatility is relatively low or relatively high. Looking at the stock's implied volatility, we can get a flavor of if the stock is viewed as more volatile than the market and with what it has been over time. Of course, some of this feel for what it's been over time is only going to come with experience, especially around our own particular stocks. Just a reminder, higher implied volatility do mean as seller of covered options that we are going to receive richer premiums. That obviously means fatter APRs, which is nice. So here's a reminder of the ideal thing to strive for, which may not always be possible, but we want to sell to open when we have high implied volatilities, and we prefer to buy to close when the implied volatility is back lower. You're going to have a tough time making money if you sell to open when the implied volatility is low and then try to buy to close at higher implied volatilities. So I encourage you to try to do this and not this. So have you ever sold a covered call on a stock you owned and the next day the stock price goes down and instead of the option going down it goes up instead? That's not what Paul said it was supposed to do. The reason this happens is the implied volatility on that option has just gone up from where you sold it. There is now more angst around that stock than when you originally sold the covered call. Remember when I talked about the optimum time to be selling options? I would always say it is best that the volatility is up on the day. Now you know what that means. All right, so we also promised to talk about volatility in investing, and we're going to do that now. Here's a little pop quiz, and you'll get to take a GoToMeeting survey to answer it. So let's say you are in a mode where you are saving on a regular basis and investing those savings immediately over the next 5 years. So as you save, you invest. So what kind of market is going to be the most advantageous to you? So your first choice is that the market steadily rises each year, goes up consistently, and by the end of the 5 years it is up 40% from where we started. Just a nice gentle ride with very low volatility. The next choice is a rockier ride. The market is very volatile and is both up and down over the 5 years. And when we get off the ride, the market is exactly at the same place as where we started. The last choice is even more volatile. The market is not only violently up and down over the 5 years, but by the time 5 years is over, we are below where we started, and we are reaching for their sickness bag. So at this point, I'll turn it over to Lori so she can run our little poll.
Okay, I'm going to launch the poll. You can go ahead and pick one of those. Okay, well, we have about 84% of the people voted, so.
I think that's good. Let's take a look.
All right, I will close the poll, and then I will share the results.
So it looks like 56% said you liked option A, steadily and consistently going up. Second was option B, at 28% that liked the volatile but ended up at the same place. And a fairly small percentage, about 16%, picked option C. So, all right, so let's see what happens. We'll assume our investment of choice is SPY, the S&P 500 Index ETFs. First scenario is A. We see every year we invested $1,000, and because the price was going up evenly every year, 100, 110, 120, 130, 140, you can see we were actually buying fewer shares each year. We bought 10 in the first year, 9, then 8, a little under 8. By the end, we have 35 shares of SPY, and at our $140, that's 40% up from where we started. Our $4,000 investment is worth $4,914, a gain of just under 23%. Not bad. Now let's look at scenario B. We can see the index dropped off to 60 for a couple years and then jumped up to 140 and finally settled at $100. Same place as where we started, but our stomachs are queasy from the ride. However, because we had opportunities to buy at the really low price of 60 for a couple years, we actually ended up owning 50.5 shares of SPY, and they are now worth $5,048, a gain of 26.2%. That's even nicer. And the little extra money helped pay for our Pepto-Bismol for the ride. But here is one that is even more surprising. This is answer C, and this is real data. Every year in Tulsa, I would teach an evening class on index ETFs and SPY. If someone would have invested their $1,000 the next day after my class, they would have seen these prices and these share purchases. So in 07, the price was almost 147, actually about where we are today, and they would have bought just under 7 shares. But in 08, they had much lower prices and bought quite a few more shares. All told, they would have bought 39 shares, and the price at the end of the period was $131, over 10% below where we started in 2007. But check this out. Our $4,000 turned into $5,134, a 28% gain from price appreciation. And don't forget, all the while we were also collecting a dividend of about 2% per year. As you know, it has been hard to live through this, but if you were saving and investing, it would have paid off for you. Those who picked the third option deserve a gold star, or they may have been a student of mine in another class and have seen this example already. When we are regularly putting money into the market, volatility can be our friend. He lets us buy more shares when the price is low, and we buy fewer when the prices are high. Didn't some kind of investing guru say the key to investing in the stock market was buy low and sell high? Maybe his name was Mr. Volatility. All right, any questions at this point?
Not quite yet. No,
all right. Very good. Well, then what I'd like to do is move to some homework posts, and just a kind of a reminder on any of our cool examples that these are always for education purposes only. There is no intention to be making recommendations on stock or options, And as always, you need to do your own research or consult a professional before doing any investing. I'm going to start with Chuck. Chuck was a star. Chuck was the only one who did the actual homework assignment that we gave out last week. He did a sell to open on a SPY call, and it was a 146 strike. He did this on Monday, on the 24th, and he sold 3 contracts at 46 cents. Cool Tool told him that his APR was 26% and that he'd be collecting $123 after commission. Chuck didn't say, but I assume this was in the virtual simulator, so I'm using virtual simulator commission rates. So great job, Chuck. 26%, over $100. It all looks perfect to me. Chuck didn't stop there. He actually went ahead and did a buy to close on that same option. And he actually did it the very next day. So yesterday, Tuesday, one day later, he went to the closing side of the option, and it said the recommendation was 7 cents, but he said, I'm going to look at it. He put in 13 cents, and the Cool Tool told him, okay, it's going to cost you $54 to close it, but you're still going to net $69, and the APR would actually be 58%. And Chuck said, how can that be? Well, we need to remember that APR is a function of 2 things. It's how much money we brought in as opposed to the asset that we exposed, our stock, but it's also the time that we did it in. And originally when Chuck put this on, he put it on the 24th, and it was going to expire 4 days later on the 28th. So that's 4 days worth of time that we were expecting to collect or capture our $123. But by buying it to close the very next day, his asset was only exposed 1 day, so we got more than half of the overall money collected, and we did it in a fourth the time. And that combination of doing it in a fourth the time but capturing half the money means that our APR is going to more than double, as it certainly did. I really appreciate that example, Chuck, and asking the question in the discussion list. That was super. Next was Teresa, and I'm giving her a hard time. The exercise was supposed to be indexes, but to her credit, she said, I couldn't find any opportunities on the indexes, but I could on Apple, and I went ahead and played with Apple. And this was, as those have read the discussion list, she was doing this in the virtual trading simulator, and she has since said she probably wouldn't be doing this with real money because Apple does, 1 contract of Apple is a commitment of $67,000. So that's not something all of us are able to play with, but Teresa wanted to in the virtual simulator because she felt like it gave her some good experience, and I agree with that 100%. So her first trade, she did a sell to open on Monday of a 675 put on Apple. Again, just like Chuck, she was looking at expiration of this Friday. She collected $4.50. It was 1 contract. We'd all love to be able to do more. And the APR was 58%. Just like Chuck, she did a buy to close, and I don't have the date here, but it actually was the very next day, so September 25th. She bought it back at $1.50, and she put that in as a limit order, and when she put it in, the market was actually closer to $2.50, so she really didn't even think that she'd get filled. But lo and behold, late in the day, she was actually filled. Net of commissions, she made about $270 in 1 day. Again, because it was in 1 day and she captured more than 50% of the goodie, she captured, in this case, 3/4 of the goodie. Her APR went up and was 146% APR. Great job. But she wasn't done. She wanted to keep playing, so she did a second trade on Apple. This was also yesterday. She did a sell to open of a 660 put, again for Friday expiration, so now we're only talking 3 days out. She collected $4.35 on one Apple contract, APR of 116%. The APR went up because the time went down. She is still waiting to buy to close that, or if she doesn't, if it gets put to her, then she will own Apple at $660 less the premium she collected. So a little under $656. Sounds like Lori may have a question.
Yeah, just a little late breaking news on this one. She said she did a buy to close today for $2, so she got $205.03 with an APR of 113%.
That's excellent. So in 3 days or 2 days, she's made almost $500 on it. So you can see why there is the allure around it. Okay, and we have one more posting that came from our friend Ron, and this was on CLF, which is Cliffs, which is a coal company. Again, it's not an index, but again, this is one that Ron thought was worthy of posting, and I'm actually applaud all of you for making these posts. I don't mean to be seriously criticizing you for not doing the index. I think this is great to be sharing. So back to the story. Ron's sold to open on today a $37.50 put for Cliffs for Friday expiration. Collected a premium of 38 cents, and he obviously did multiple contracts. I don't think he told me how many, but his commission spread over the contracts meant that it was roughly a penny a share on the commission. The APR was 185%. Same on this. Ron's waiting to either buy to close it, or if it gets put to him, he will be buying CLF at $37.50 less the 38-cent premium. And as he says, if it is put to him, he'll immediately turn around and start selling covered calls on it. Kind of like what I recommend doing on indexes. It's not my favorite to be doing it on the individual stocks, but if it works for Ron, it works for Ron. Ron also had a nice interesting comment in the posting that says when he calculates APRs on weeklies, he actually looks at the money being tied up all the way to Monday rather than Friday. So as far as how many days you have left, essentially, and if you were doing it today instead of just saying 2 days to Friday, he would add 3 more days and go out till Monday. And by doing that, it drops the APR a little bit to only a pittance 74% APR. And with that, I gave him a smiley face. And our last posting came from Sharon, and she did a couple different puts. First one was on Coach. This was yesterday. She sold a $55 put. This is for an October 20th expiration. She collected $1.80, APR of about 45%. At this point, she hasn't closed it, and she's waiting to buy to close it. If it gets put to her, then she will buy Coach at $55 less $1.80. And I'm always teasing Sharon because she always gets a nickel more on every premium that she sells that I'm doing as well. But I have to tell you, Sharon, in this case, I got $1.85, so this time I beat you by a nickel. I happen to have done the same trade. The other one she did was on Quality Systems, QSII. She did a sell to open. This one she did today. It was a $17.50 put, again for October 20 expiration. She collected 55 cents. Again, the APR was north of 45%. And again, she's waiting to buy to close that. If it is exercised, then she will be buying Quality Systems at $17.50 less the 55-cent premium. And she just wanted to remind on her posting, and I just want to remind on all these examples, these are not investment recommendations. They are just examples of some trades. Before doing anything similar, you need to be doing your own research and investigating both the options, but particularly when you're doing stocks, you need to be comfortable with the fundamentals on the stock before you ever sell any option on the stock. Next week, October 3rd at 5 p.m. Eastern Time, we're going to talk about the topic of why we sell rather than buy options. And as a homework assignment, I like what is going on where people are sharing some things they are doing or trying. And I think it would be good to make sure you spell out when you do this whether it's in a virtual account or not, so that people can take that into account. But I say keep up the good work. We won't be restrictive. Feel free to post any covered options that you have been selling, and or come back and tell us when you've bought back ones that you have told us about opening with a sell. All right. Ran a little longer than I thought I would, but at this point I'm going to throw the floor open for kind of general questions that can be around options. If you want us to pull up the Cool tool and look at some options on a stock, we can. If you have questions around the Cool tools, we can entertain those as well. So it's pretty much an open floor.
The question of, I guess Teresa's brought up again, the sell to close, and she's just asking what that is.
Well, when we do stock, we don't call it this, but we typically buy to open, and when we get ready to sell it, we sell to close. Well, you can do the same thing on options. You could start by buying to open. That's not what I recommend you do, and we're going to talk about why not next week. But if you buy to open a position, that means you own the option. That means you have the right to exercise. Then when you get ready to, instead of exercising, one way you can close the position is by selling to close. So sell to close only fits when you have started the option by buying, something that I personally don't believe in and don't recommend doing. But more about that next week.
Okay, there's a question here from Ivan. He's saying, does implied volatility help us in deciding at what price to sell to open?
I think it's always interesting to look at the implied volatilities and see how they're tilted, whether sometimes they're going to be going up as prices go up, sometimes they're going to be tilted towards the downside. So that tells us a little bit about the market and what the market's general tenor is. It probably isn't going to pinpoint the price we want to sell as much as the discussion we've already had with the Cool tools around if it's a call, what's your minimum price to sell? If it's a put, where's your buy level? So those are going to drive it more. Now, having said that, every once in a while you will see discontinuities as you look at the implied volatilities. What do I mean by that? Well, most of the options might be at, let's say, a 25% implied volatility, plus or minus 1 or 2, and all of a sudden you'll notice that at a certain level, and it can be up or down, it'll jump by 5 or 10 percentage points. And those are worth looking at, because that says for some reason somebody wants some business done and is willing to pay up at that particular strike. And those are always fun to look at and understand, and that might change my opinion on what strike to do. So look for those discontinuities.
Great. Here's a little more basic question, Paul. Jack is asking, in your examples that you just went through, could you maybe run through them really quickly and just point out that was the money earned because the underlying stock price went up or down?
All right. So in every case, when on Chuck's example, he was selling a call, and the only way he was able to buy it back the next day is because the underlying commodity, in this case the SPY, went down. So his actual SPYs went down in value, but in the meantime he was able to collect a little bit of money, defray his loss on his SPY, and get ready to sell a call again the next day. In the case of our puts, every time you sell a put and you're able to buy it back, that means that Teresa was able to find a point where she could sell the put, and then Apple moved up, which allowed her to buy the option back at a lower price. So if you sell a put, which means that the stock might get put to you at that price, that only happens if the stock continues to move down. Is it going to get put to you? If the stock moves up, then you have the ability to buy back the option, pocket the difference, and get ready to sell another put either on the same stock or something else, because you're back to just having cash that's freed up. So in both this case, Apple must have moved back up from the point that she sold the option. Same with Ron. He's still waiting to buy this back to close, but he'd only be able to do that if Cliff moves up from the point that he sold this option. Same with Sharon. These are both puts. So for her to be able to buy this Coach back, Coach would have to go up from here to be able to buy it back at a lower price. Same with Quality Systems. To buy it back at a lower price, Quality Systems would have to move up. Any other questions? Or?
I don't see any other questions here.
Well, very good. We have covered a lot of ground. I hope it was useful for people. And at this point, I think we'll say good night and good selling.